Welcome back, traders. Thanks for joining me here today. In this short video, you will get to know the difference between the bar charts and the candlesticks chart. The bar chart is the Western representation of the movements of price chart. It is created using the information set by price through the opening, closing, high, and close of price in the market. This price presentation technique focuses on the highs and lows of the current bar compared to the previous bar. While candlesticks charting technique was originated from Japan, and this is why it's been referred to as the Japanese candlestick. This form of charting technique was used by the Japanese traders since the 1700s, and this is the most popular charting technique used by Forex traders because they are visually easier to interpret. The candlestick charting technique focuses on the relationship between the bodies and the wicks. Here's the anatomy of the Western bar chart on the left side here. And the right box here houses the anatomy of the Japanese chart. Diagram A is the bullish bar. Diagram B is the bearish bar. Diagram C is the bullish candlestick. Diagram D is the bearish candlestick. As we can see in diagrams A and B of the bar formations, price opens from the left-hand side and closes on the right-hand side. The difference between the bullish and bearish bar is the level of the opening and closing of the bars. As we can see on the bullish bar, price opened from the low level and closed near the high level. While on the bearish bar, price opened from the top and closed near the low. On the diagram C and D, the bullish candlestick opens from the low level and closed near the high. Also, the bearish candlestick opens near the high and closed near the low. The main difference between these two Japanese candlesticks is the difference between the color of the bodies. The bullish Japanese has a green-colored body, and the bearish Japanese candlestick has a red-colored body. Making conclusions based only on the formation of bar or candlestick in isolation is a dangerous way to analyze the market. This is because they only pay attention to current price action, and this has a lower probability of trades and sometimes may confuse traders in making the right decision. Blending them with other factors, such as support and resistance, long-term patterns, and volume, make them become reliable. We will focus more on the Japanese candlestick because they are the commonly used and easiest charting techniques in technical analysis. There are lots of Japanese candlesticks patterns, but we will focus on the ones with the highest winning rate in my trading records. The first Japanese candlestick I will educate you about are single candlesticks. The first Japanese candlestick on the list is the doji. The doji is an example of a candlestick that open and close at approximately the same level. There are different variations of doji candlestick, ranging from the long-legged doji, the high-wave doji, doji star, the dragonfly, the gravestone. The most important thing to know about these Japanese candlesticks is the technical implication on the trading chart. The doji signifies a sideways market. The combination of price movements in a ranging medium on the lower time frame results in the doji formations on the higher time frame. A sudden breakout of this ranging market could lead to the correction or reversal of a trend. They also signify low liquidity in the market. The next single Japanese candlestick on the list is the hammer. It can also be called the bullish pin bar. The bearish formation is called the shooting star or the bearish pin bar. As we can see, here's the anatomy of this Japanese candlestick. The body or the head. The nose. Sometimes there may be an absence of a nose. Here's the neck. And here's the tail. Take note, for this Japanese candlestick to be genuine, the tail must be at least 2 times the size of the total body and the nose. You will come across a lot of candlesticks like this pattern. Therefore, before concluding it's the real one, make sure you examine the length of the tail in relation to the head and nose. Whenever the hammer, bullish pin bar, appears at the low of a bearish trend in combination with a support level, it usually signals a potential reversal of the bearish trend into a bullish trend. As we can see on this chart, it appeared at the previous support for price here. We can see how it led to the reversal of the bearish trend into a bullish trend. Also, whenever the shooting star, bearish pin bar, appears at the top of a bullish trend in combination with a resistance level, it usually signals a potential reversal of the bullish trend into a bearish trend. The hammer, bullish pin bar, and the shooting star, bearish pin bar, are my most preferred candlestick among the Japanese candlesticks. The hammer can also appear at the top of a bullish trend instead of at the bottom of a bearish move. Whenever the hammer, bullish pin bar, appears at the top of a bullish trend, it's called a hangman. The hangman is not quite as reliable as a bullish hammer. However, it does signal weakness in the preceding trend and indecision at the supposed top. Also, the shooting star, bearish pin bar, can appear at the bottom of a bearish trend instead of at the top of a bullish trend. Whenever the shooting star appears at the bottom of a trend, it's called an inverted hammer. The inverted hammer is not as reliable as the hammers because it showed the bulls attempted to push the price higher, although the session still closed nearer to the lows. However, it suggests the bearish trend is losing momentum. For now, master these Japanese candlesticks for a start as a beginner in technical analysis. In the next video, we will proceed to the other Japanese candlesticks.